evening, everyone, and welcome to today's session. I'm Ghazal Jain, and I'll be hosting this webinar today. Before we begin, please ensure you're connected to the audio and use earphones for a better listening experience. Thank you. I'm glad to welcome our speaker for today, Mr. Chirag Mehta, Senior Fund Manager, Alternative Investments. With bank fixed deposit rates at decade lows and inflation inching up, Chirag will be talking to us about the challenges and limitations of a traditional fixed deposit investment. He will also delve into the alternatives available for a fixed deposit investor to park their hard-earned money. Thank you, Chirag, for being here with us. Chirag will be answering live questions post his presentation, so we encourage you to send across your questions on the chat. And with that, I hand it over to you, Chirag, to take us through your presentation.
Thank you, Ghazal, and thank you everyone for joining in today. Today, I hopefully will take you through a journey. I mean, I do really know that it's a pain point for most of us grappling with the low fixed deposit rates that are there. And it's been sliding continuously. What to do, what not to do, how should we kind of battle this falling or low interest rate regime that we live in today? At the same time, when our costs are increasing significantly, inflation, if you look at official numbers are one thing, but we all know what hits our pocket the most, right? And every time, it's very difficult to reconcile with the figures reported by the governments and say to it that inflation is it so low, you know? So overall, what is happening is our fixed deposit rates on a real basis are giving us lower and lower returns, right? That doesn't do good to our standard of living that we have. We all need a higher return, or at least return matching inflation, to keep at pace our wealth, to help us increase our standard of living. And that's not happening today. Let's see how we can change it, right? So if you look at the current fixed deposit rates offered by various banks out there, right, is somewhere between 2.5% to maximum 5.75 to 6%. And we all kind of, to get that higher return of 0.5%, 1%, try various different avenues in terms of, and invariably take so much more risk that we are not willing to take, right? So maybe something is on the credit side is far more riskier, but giving you that 1% higher return, we all kind of move towards that because, it is at the end of the day called a fixed deposit or a fixed return instrument. But at the same time, there are various risks that entity or that financial institution may go bust. What happens to your money? That 1% return is not worth that risk that you take going into such kind of instruments. And if you see, it's not now. It's right from 1990s, 2000s, we have seen that every rate slide, what we were comfortable with 10, 12% interest rate regime has now come down to around 5% kind of regime, right? It's continuously following and making everyone ponder how we can, fight this menace of falling interest rates and earn us a better return, right? So don't take over risk that too for a paltry amount of 0.5% or 1% and go into places which you don't understand the risk of and therefore invariably take a lot of more risk. And I think it is common across India. We are kind of some conservative mindset and therefore, the assured return kind of pulls us through despite knowing the facts that it doesn't do us a favor. It does injustice to our hard-earned money, right? Like 53% of household financial assets are in deposits. And it's not only today, it's since 1980s, 1990s, we have seen this trend persist. And it's so ingrained in our psyche that we invariably tend to move towards that area. The only place where we kind of made a right move was around 16, 17, where our proportion of cash and bank deposits fell significantly and the proportion of other assets increased significantly larger. And that is the way we need to move about because FDs at the end of the day are a losing proposition. And I will show you why. First, when we look at fixed deposits overall, what happens is what are the benefits that we're kind of attracted to is assured returns, the most and the biggest, because we know that at the end of the term, we will get that return, right? Second is there is, earlier a deposit insurance of 1 lakh rupees, now increased by the government to 5 lakh rupees. So to that 5 lakh rupee, there is an assured of your money, you're not losing your money, right? And there are possibilities of getting you loan against FD, which is again a very bad combination, because in the FDs your LE which is earning low, and on top of that, when you take a loan, it will be at least 2 percentage points higher than that, right? But we kind of get that comfort that there is a loan available in fixed deposit. Now, what are the disadvantages of a fixed deposit? Firstly, returns are low, and as we have seen in previous slides, that has been falling, and currently at very low levels, and doesn't keep pace at all with the cost of inflation, and therefore the real returns that we get, which is returns on your fixed deposits minus inflation, is low or at most times negative, right? So you are on a real basis earning a negative return by doing that fixed deposit. We'll show you hard numbers for that. It is insured only up to 5 lakhs. What about that? What if there is a systemic crisis? What if there are many financial institutions going bust at the same time, right? What happens during that time? You are only insured up to 5 lakh rupees. And if you have 25, 30 lakh rupees parked in a fixed deposit, what happens about anything above the 5 lakhs? It's not insured, right? What happens? There is liquidity, but it comes at a cost, right? If you're doing a FD at 5%, and if you want to premature withdraw that FD, you end up paying a penalty on it, and therefore your real returns are even lower than what is stated on your fixed deposit, because you get the card rate. And card rate, say if you are doing a 3-year FD and you're unlocking in say 6 months, then you get what was the rate prevailing at 6 months, which will be not 5% or 6%, but around 3%, right? And the biggest issue with fixed deposits is they are not tax friendly. Whatever is your tax slab, you are being taxed based on that, right? Whenever you get interest, you kind of pay tax towards it, right? So if you're a 30% bracket, you get a 30% tax on your fixed deposits. So it's not efficient from a taxation perspective, not at all. These are hard numbers one should look at each time when you make an investment. When you make an investment, one thing is common, right? Your cost of expenses, your expense level, your inflation keep inching higher. It's like the meter of a taxi or a rickshaw, which kind of keeps ticking no matter why are you moving or you're not moving, right? Similarly, cost of inflation doesn't matter, doesn't care whether you're earning enough or not. It will keep ticking at its own pace. Your household expenses in 1990 was just short of 24,000 rupees. Today in 2020, the same consumption basket, same kind of expenses towards food, expenses towards travel, expenses towards education, expenses towards clothing, footwear, all that combined makes your consumption basket. What used to cost you 24,000 in 1990 have increased all the way to 4,27,000 in 2020. That's an increase of 10.1% every year. Even from 2015 to 2020, it has been 9% every year, right? So what inflation numbers you see out, 3, 4, 5%, doesn't really match with the spending we all are doing. Our expenses are increasing by 9, 10%, right? Offload higher, it was higher before. Now inflation has come down a tad, but it's not like 5, 6%. It is around 9% today still, right? Gold prices have more or less kept pace with the spending basket. Spending basket has increased by 10%. This has increased by 9.4%. So to an extent, it has kept pace. Small increase in prices going from here will kind of match that spending increase that we have seen, right? Equities have done phenomenally well, right? You needed 33 units of your equity investment in 1990s. Today, you only need 9 units of your equity investment. So equities have grown by 14.9%, helping you to increase your standard of living over time because it has increased more than inflation. Fixed deposits, you require 22 units of your fixed deposit to buy that consumption basket in 1990. Today, that same thing is needing 73 units of your fixed deposit basket, and it has grown only by 6% per annum. So on a real basis, you have lost about 4% every year since 1990 to earn the same spending basket if you were in fixed deposit, right? Fixed deposit, we have assumed that it is quarterly compounding, which is not usually the case. And we have assumed a tax of 30%. So if you're at 30%, this is very much applicable to you. So 6% has not done you a favor. It really shows you that it has been a losing proposition, putting your hard-earned money in fixed deposits. But what do? We want something that can help us here, right? Like other assets have done well. Should you just move into those assets, right? Like equities have done phenomenally well over the long run. Should you go into equities completely? The answer is no. And there are valid reasons for that, right? Look at equities, the blue box. It's been very, very volatile. Like 2006, 2007, phenomenal returns. 2008, whatever value you had made sitting in equities declined by half, right? So it kind of moves all over the place. Returns are very, very unpredictable, very, very volatile, and therefore you can't put all your money in equities, right? Bonds at the same time have given sometimes higher return, better, lower returns. They, in a way, have not given since 2006 a negative return out there. So to some extent, you could rely to some extent on bonds, but returns are again lower, right? If you look at the returns, it is usually lower, or on a whole period, it will be lower than your inflation probably. Gold is a great asset, but again, it's volatile, not to the extent of equities, but again, still volatile, and it has its own cycle, right? So if you look at different points in time, there are different asset cycles originating from optimism and pessimism of each asset classes. Sometimes you have a debt rally in 2001-2, then you had an equity rally from 2003 onwards. Then 2008 onwards, you had the gold rally significantly. So these different periods, different asset classes had their own cycles. So something, if you can do that utilizes these market cycles to your advantage, and at the same time ensure that, as the cycle matures, you kind of lower your risk at each time, then that is a great combination that you have, which will ensure lower volatility and a great return for you, right? But that is easier said than done, right? That sounds awesome. That sounds super, that I can be in equities at this time, I can be in bonds at this time, I can be in gold at this time. But it's very, very unpredictable. Why? Because if you see, since 1994, there have been different phases in market, right? Right. For example, there have been different crises that we have seen, and some were really, really unpredictable, right? Which we call as black swan. Typically, markets will tell you all these are black swan, but not really, right? Many of these, we knew we were heading towards that side, right? So many of them are predictable, and therefore you can time those cycles well. And some are really surprises, which no one can time, right? Like example, 9/11 attacks in the US, markets fell after that. SARS in 2003, no one could predict that kind of a pandemic coming. Demonetization, no one could predict that such a move any government could make. And 2020, the COVID crisis, no one saw it coming in a big way, right? So to some extent, you can price many of these things. Some are unpredictable, but we'll have to live with it. But there are ways you can overcome these kind of issues as well. So, is there a way? The kind of the asset cycles you saw, the kind of market cycles you saw, is there a way we can mix all that and give you something that can give you a better return than your fixed deposits, and at the same time not take too much risk? Because that is what why we are in FDs, right? We don't want to take over risk. We want predictability of performance, and therefore we are in FDs. So when we are looking for options to FDs, right? What are we looking? Are we looking at better returns? Are we looking at low volatility? We are looking at better predictability. I know after in a long term or a certain period of time, I know what my returns are going to be. It could be plus minus 0.5%, 1%, but I know what's the range going to be, and something that protects your downside. That is exactly what you're looking for today. You're looking for options for FDs, and these are the trades that I think each and every one of us will be more comfortable with and willing to part if these things are a tick mark out there. Better returns, lower volatility, better predictability, lower downside risk. So as I was showing you different cycles, every asset goes through cycles, and each cycle there will be a valuation metric, right? And that helps you navigate these markets. For example, a simple allocation, like for long term, since 2004 till now, equities have given you 12.5% return. Debt has given you 7% return. Gold has given you 11.4% return. At the same time, equities, the biggest fall that equities saw was 56%. Debt saw a fall of 6%, and gold saw a biggest fall from 2004 till now. The biggest fall that it saw in a particular period was 25%, right? So much lower. So what this tells you, and another thing that you can look at is volatility, how the prices move in a particular time, right? So equities has a volatility or a swinging factor of 22%. Debt has a swinging factor very low of 3%, and gold has a swinging factor of 17%. So if you were to just combine equity and debt, you could have got a return. This is a 60-40 portfolio, a 60% in equities and 40% in debt. Your returns would have been 11%. Your volatility, the swinging factor, which equities has 22%, it would have been reduced to 13.5% because the swinging factor of debt is much lower. And the biggest fall that equities saw, 56%, would come down to 36% because debt's fall is much lower, right? Similarly, if you, instead of two assets, equity and debt, if you were to combine three asset classes, equity, debt, and gold, right? You still would have better return of 11.05%. This is a combination of 40 equities, 40 debt, and 20 gold, right? 11% equities. The biggest fall that you have seen could have been 21%. From 56% of equities, you would have come down to 21%. And your swinging factor, volatility as it is called, would have been around 9%, right? But many investors may not be happy with a 21% fall and a 9% swinging factor, right? They would be happy with 11% return. But if they want that lower, if they want the volatility lower and the drawdown lower, what they have to compromise is a bit on the returns aspect. If you compromise a bit on the return aspect, because volatility and returns, risk and returns are two sides of the same coin. You cannot have one without the other, right? But you can limit that risk and still earn a better return, right? So it is nothing but understanding what each of the asset class brings to the table, and a judicious mix of equity, debt, and gold will earn you what you want. That is a better return than your fixed deposits, and at the same time, lower risk, lower swinging in terms of volatility. So equities, we all know, are for long-term growth. Fixed income gives you stability and a regular income, and gold gives you that hedge or diversification against the risk that is out there, the unpredictable events that we saw, right? So if you look at this chart, it tells you that the good prices and good news don't come at the same time. Like, for example, before COVID, markets were really expensive, and therefore suggested allocation to equities would have been much lower, around 25% mark, which is shown by the blue bars, right? In COVID, markets became really reasonable, and it made all more sense to increase your equity allocation. And therefore, something like a 50% allocation in just 1 month's time frame would have got you a better portfolio, and therefore a play on the rebound that we saw last year, right? And therefore a chance to make more money. Similarly, when there are not good times, you need to refrain from taking risk. Like if you see from 2012, barely it has exceeded the 45-50% mark in terms of the equity allocation. And this kind of looking at allocations will help you on the returns that you want. So take risk only when it accounts for, or whenever it is helpful, or whenever it is screamingly telling you that this is the time to take risk. And you can do this perfectly, right? And that is what we have done in the multi-asset fund. And firstly, before going into details, let me run you through the returns, right? Since inception, return of 9.5%, 7-year returns of 9.3%, 5-year return of 9.2%, 3-year return of 8.5%, and a 1-year return of 16%, right? If you look at the longer time frames, since inception, 7-year, 5-year, the long-term time frames, or even 3 years, it's closer to around say 8.5 to 10%, or farther than 5 years, it's around 9 to 10%, right? In that range. So that really tells you that it is very, very consistent over long time frames, right? Short terms can be volatile, like what you saw 16% in 1 year return could have been, say, 4%, 5%, or even negative in a 1 year. But if you were looking at a longer term, the allocations will help you tide the volatility and give you much more steadier, much more predictable return that you're looking for. So if you look at the orange line, that's a SBI 1-year deposit renewed after every 1 year, right? And the blue line, if you look at, is the quantum multi-asset fund. So what we're trying to do in the multi-asset fund is give you an alternate to fixed deposit, while at the same time taking a very low risk. So if you were in the blue line, the multi-asset fund, it's only 336 days out of 3,215 days, that is 10% of the time, you would have regretted your decision to be in the fixed deposit, right? And 90% of the time, you would have said a good decision, it has given me better returns than the fixed deposit, right? Usually what happens is we want to park money for long term in fixed deposits, but we kind of keep it shorter term fixed deposit maturities so that we know that there is some money coming to us, which if things are okay, we will kind of go ahead and renew it, right? This is a typical way in which people do their fixed deposits. But if you look at the blue line, and as you saw, FDs were a losing proposition, a return of somewhere around 9.5% would have helped you on better returns than your fixed deposit and better return than your inflation. And the standard deviation, the volatility, the swinging factor that we saw is just less than 6%. So it shows you that it is a very, very steadier line, except episodes like COVID, which was very, very sudden, and markets fell by 40% in a very short time frame, right? Despite that, the fall has been very, very shallow. People look at it from a 3-year perspective, right? People park in fixed deposits. People park in fixed deposits and they kind of wait it out and renew every year. But look at from a 3-year perspective, right? If you are in fixed deposits, your trend line of 3-year rolling returns. So each point on the lines are 3-year returns. And in these 3-year returns, it's been falling because interest rates are falling. So you're renewing your FDs and each time booking your FDs at a lower rate, right? So what used to be a rolling return of close to 9% has come down to a rolling return of around 6% mark, right? So the 15% of the time, you would have said on a 3-year basis, the FD makes sense for me. But 85% of the time, you would say the multi-asset kind of structure, which is an asset allocation structure, works better for me, right? So, so this really tells you that on a 3-year basis, that the blue line has done at most times better And if you see, there have been return phases of 10, 14, 12% kind of levels. And any point in time, it has not gone below the zero line. So at any point in time on a 3-year basis, you have never earned a negative return. No matter when you invested, if you're waited out for 3 years, you have never made a negative return. And on an average, we'll look at the average returns in the next slide. You have done better than your fixed deposits, right? So that's the beauty of it, that most of the times you will earn better returns. And if you have the ability to wait it out a little longer, you would earn better returns than your fixed deposits. Biggest issue with fixed deposits is you are taxed at 30%. If you're in a 30% bracket, at 30% on your fixed deposits. Wherein the blue line, if you waited out 3 years, then your effective taxation, if you're in a 30% tax bracket, your effective taxation, because of the indexation benefits it provides, comes down to less than 10%, right? So whatever you earn, whatever in this blue line and the orange line differential gets further bigger because of the tax benefits that you get on, because of multi-asset fund being an instrument which is taxed at 20% with indexation. So effective tax comes down to less than 10%. So this is further a very, very big advantage to all of us who are looking for an alternative to FDs. And this is what I was talking about, right? Even in the bad times, it has given you a return of 1.5% in a minimum basis, and maximum return that you got is 13.6%. So even on a 3-year basis, you have never earned, you have at least earned 1.5%. Maximum return that you would have got on a 3-year basis, 13.6%, which is far higher than your fixed deposits. And on average, you would have earned since 2012 till now, if you were in the multi-asset fund, you would have earned a return of just about 8.7, 8.8%. So that is again better than your fixed deposit. That is at least about 1.5% more than your fixed deposit, while you took very little risk, right? Little risk. Risk is in terms of your capital going or not, right? You're losing your capital or not. At no point in time on a 3-year basis, you would have lost your capital. And if you look at the different asset class, of course, equity has been a clear winner, the green line. But if you see, it's been all across the place, very, very volatile. And you don't know when you will need money. And it could be the time when markets have fallen by 40, 50%, and that is the time you need money. And then you will have to sell your equities for that lower value, right? So to avoid that, look at the blue line, the dark blue line, right? It's a multi-asset fund. It's so steady. It's very, very steady, right? And at the same time, giving you better returns than your liquid funds, than your bond funds, than your fixed deposits, right? So what will determine, what are the things that we look at, and how can you ensure that this trade will remain going forward as well, right? Let us look at asset classes, right? Let us begin with equities. So equities, what is material? What is end of the day that determines what kind of returns equity makes? Equity markets at the end of the day, no matter there will be speculation, there will be volatility, there will be different factors. At the end of the day, it will move as per earnings of companies that are in the index, right, or in the stock market. So earnings is one thing that tells you, or something that you can bank on, which is very, very fundamental. And that is what we see when we make our decisions. Bank on valuations as a measure to tell you that what can you expect from equity markets going forward. Right? That determines our allocation to equities. At the same time, when we are looking at earnings growth, we also look at what level the valuations are today, right? Earnings can be fantastic, but if the market is already pricing in that or not, right? It could be very well that markets are overpricing that strong earnings that are coming, right? So what is the PE ratio? Not only historical, we also look at forward. What is the expected PE going 2 year out, and that will tell us what kind of confidence we play and what kind of allocation we have towards equities. Coming to fixed income, what we are seeing today is there is high level of government debt, right? Government debt has increased because of COVID spending that they have to do. And to pull the economy out of doldrums, there will be a lot of government spending happening, and therefore the fiscal deficit is large. At the same time, we have seen RBI coming and saying that we will help the economy, we'll help the government, we will buy a lot of bonds. So you have the RBI coming and saying that we will remain accommodative, we'll keep rates low, and we'll not let bond markets be pressured. We will come and participate and buy excess bonds that are there, excess supply from the government that is there. At the same time, on the other hand, you have inflation inching higher. To what extent the RBI will be able to remain accommodative when there are so many inflation pressures? Look at commodities. A lot of metals, oil, agri commodities are trading at much higher levels than they were at. Many commodities on the metals and agri are at multi-year high. They are at 8-year, 10-year, 12-year high. So inflation pressures are real because of the liquidity being pumped in by central banks across the globe. So these are factors we need to keep into account when we are placing money in each of the asset classes. So what kind of return expectations we should have from each of the asset class. For example, bond markets will not have the good returns that we saw last 2-3 years because much of it is priced in, and there are pressures from high government supply, high inflation out there, and it is only to be seen till what extent the RBI can hold the fort. Coming to gold markets again, gold looks very fundamentally very attractive, and why we say that is because if you look at a crude measure of gold valuation, right? Gold at the end of the day is money, and look at the money printing, which is the red line that has happened of late because of the issues in terms of COVID, and therefore government spending a lot more money and infusing a lot more money in the system, giving handouts to everyone, giving support to businesses, and therefore that red line has just moved sharply higher. And gold has followed a suit. But if you see, the red line is still inching higher. The growth rate of money supply in the US is still around 20%, right? And if you see, gold prices have corrected because of the optimism that we are seeing towards economic recovery. And therefore, today, when we look at gold in perspective to money supply, which is, again, gold is a monetary asset, it's a tad undervalued. That really tells you that gold is still an attractive place to be. And we see an environment of real interest rates to be negative. What are real interest rates? It's interest rates minus inflation. So whenever we have a realm of negative real interest rates, gold does well. We saw it in 1970s, 80s. We saw it in 2006-07. And therefore, even now, when we have negative interest rates, gold is doing well and will likely do well because this scenario is not changing in a hurry. So overall, gold looks attractive. So you need to look at what is the forward-looking outlook of all these asset classes and make an asset allocation that has to be unbiased, that has to be dynamic, and that has to be agile, right? When we say unbiased, right, it has to be across asset classes, and it has to give you the flexibility that allows you to move in a range in a wider manner, right? For example, if you were to look at when we say unbiased allocation, the equity allocation that we have in the multi-asset fund is 25-65, debt also 25-65, and gold, which acts as a diversifier rather than a return generator, is between 10 and 20%, right? So, so you need to have a mix. Many asset allocation funds or many dynamic allocation funds are biased towards a particular asset class. Many of them will have equities minimum at 65%. When you are having equities at 65%, you are taking very similar risk or almost close to risk that you take with your equity investments. Because even if the fund manager doesn't like, they have to stay minimum 65% invested in equities. And that doesn't help you to bring down the downside risk, to bring down that volatility, to bring down that swinging factor, right? You want something as an alternative to FDs, you need to be allocated in a manner that allows you to reduce your risk considerably whenever it warrants to. Second thing is you need to be dynamically allocated. And the biggest thing that you can rely on for which asset class will do well is to bank on valuations. If valuations are high, and I'm not saying only historical, I'm saying a relative valuation or even a valuation that is forward looking, that helps you to determine how much money to you put in each of the asset class. Today, equities, given all what we are seeing, are expensive. The valuations are expensive. Earnings, there could be uncertainty on earnings. And when you look at in relation to what bonds offer in terms of relationship or relative value between earnings and bond yields, that tells you that you need to have a lower allocation to equities if you were to minimize your downside risk. So at all points, if you are looking to an alternative to fixed deposit, you have to ensure that at each point, you are reducing your risk and returns will come. Whenever there is, you cite a risk, you have to reduce your exposure to that risk. That's the bottom line. And that is exactly what we do in the multi-asset fund. So that we can give you a much predictable product where you can park your money for the 3 to 5 year period and earn a better return than your fixed deposits. And today, fixed deposit, although they will give me lower return, it will help me protect and bring stability to the portfolio. And whenever there is a need for me to take risk and go into equities, it allows me to easily switch my investments. And gold, we have a range of 10 to 20%. We ideally use 10 and 15%. The rest 5% we allow for market appreciation only. So we are at optimal allocation in gold because gold is looking very, very attractive. So we are maxed out on gold and had a 15% allocation, and these allocations have to be very, very measured, right? And third thing is to be agile. When things were not warranting in our history of the multi-asset fund, we refrained from taking risk, right? We remained at 45%, 50% allocation. And at times, like times before COVID, market valuations were really high. We did not predict COVID, but we knew that market valuations were stretched. And therefore, our equity allocation was around 25, 26% at that time. And when COVID struck, it gave us an opportunity. We showed our agility. We increased our allocation to equities from 25% to 50% in just 1 month. Within that single month from March 1st to March 23rd, not even a full month, we increase our allocation from 25% to 50%. So when you are watching it every day, when you have your valuations at your fingertips, you are able to take these kind of calls, right? And show your agility and go into that asset class and get the higher returns that you are looking for. And when things get again expensive, we have again lowered our allocation to equities. We don't want to take risk on your behalf. And we are at minimum 25% allocation to equities at this point in time. And if markets correct, like it did in March last year, we will again, as maybe good for investors, we will increase the allocation to equities. So when you're considering an option as multi-asset fund, what you need to do or what you need to understand before you jump into it is that we kind of diversify across asset classes. We try to reduce risk at all points in time, as I have said. We reduce dependent on a single asset class to generate returns. So we have a broad, well-diversified portfolio. You need not time the markets. We will do it for you, like what we did over last 1-2 years or since 2012. We are watching your risk. And whenever the risk allows us to move and take risk, we will do it for you, right? And you don't have to worry about rebalancing because, whenever there is a need, we will rebalance and therefore book profits wherever it is required. And otherwise, we will let the portfolio run and generate returns for you. Also, it is very, very tax efficient. And especially 3 years and more, it becomes really tax efficient. And one more thing, even if you're doing your asset allocation on your own, whenever you change your allocation from one asset to the other, each time you pay a tax. Whereas we being a mutual fund, whenever we change allocation, there is no tax element involved. Mutual funds do not have to pay the tax, and therefore investors also don't have to pay the tax whenever the allocation changes. Only when you book or you exit or redeem, that is the time, depending on your gain that you have made, that is the only tax you have to pay, right? And what we are trying to give you a smoother ride and reduce that swing factor is, as I've said, that the swing factor for multi-asset funds since 2012 is less than 6%, right? So it's very, very low. So it's been a smooth journey, a smooth ride for investors. So as investors, the basic lesson that we all get is what we really focus on, and we don't have control on it, is returns, right? Most of the time, 90% of the time or energy we spend choosing our investments is focused on returns, right? And we have no control on what kind of returns that's going to be, right? What we can control and what we can really focus on is what is the risk, what is the cost involved, what is the time that I will require in terms of what is the holding period that I need to have, and what is the behavioral trade. Do I need to watch it every day, or should I leave it on the fund manager, right? That's all in our control and we don't focus on. So when you're looking at an alternative to fixed deposits, look at an alternative to fixed deposits. At that time, don't compare it with equities, because when you compare it with equities, compare also the risk that you get along with equities, right? So when you are comparing, compare apples to apples, oranges to oranges, not apples to oranges, right? So it is time that we all move from the shackles of FDs, because FDs at the end of the day are losing proposition. There are proven ways, there are time-tested solutions out there that mutual funds offer and give it to you, which kind of give you that better return. At the same time, protect your downsides, protect the volatility, and therefore give you a smoother ride. You don't have to lose sleep at night just because you are invested in something. Here you can invest, sleep peacefully, and have a better return at the end of the day. So make a prudent choice today. It is extremely, extremely important that you do it. And next time you renew your FDs, you look at booking a new FD, please think about the quantum multi-asset fund. That really helps you get a better return and look at what you are really looking for. So make that prudent choice next time you are thinking about doing an FD. With that, I hope I've added some value to you. And with that, over to you, Ghazal, and happy to take any questions that you have.
Thank you very much, Chirag. I hope you all enjoyed this comprehensive presentation. If you haven't yet asked Chirag your questions, you can still do that by sending your questions across on the chat. We'll start with the first question for you, Chirag. Can you please suggest a safe investment avenue for the recently retired people for regular monthly income?
So when it is a regular monthly income, is what I think is you're looking for is something that can help you with your expenses, right? Something that is very, very predictable and very, very assured in terms of, because you're banking on it to make your monthly expenses. And if that's the case, then you have to choose something like fixed deposits or or something that is fixed. But what mistake that we end up doing is park everything that we have into that same asset or into same instrument. We need to bifurcate what is required for me for that monthly expense needs, and what is over and above that I'm not really bothered of, and I can wait it out for say 3, 5, 7, 10 years. You need to bifurcate that and ensure that only to the extent I need in terms of fixed deposit, I mean fixed returns or assured returns to handle my monthly expenses, only that I put in fixed deposits or any good AAA kind of company deposits or a guild fund, something of that sort, which doesn't take much risk, or a dynamic bond fund. I will not suggest a dynamic bond fund or bond funds for retail investors, because you don't understand the risk. Because the biggest risk in a bond fund is it can also give you negative returns. That is not many people think when they make a debt investment. And therefore, if you understand that space, then only go into that, because bond funds can also give you negative returns, right? No matter it be government securities or GSECs as they are called, it can still give you negative returns, because if interest rates move up, that bonds can give you negative returns. So when you're looking for a fixed monthly expenses and banking on some instrument, it has to be something like FDs, but don't club everything into that FDs, right? Something that is a little longer term, you can go into instruments like multi-asset fund, which give you that higher return and at the same time take only little higher risk.
Thanks, Chirag. Coming to fixed deposits, there is a provision for extra interest of say about 0.5% for senior citizens. Likewise, in the fixed income schemes of the mutual fund, is there any such scheme now, or can it be devised?
I think banks, if you look at banks that give you that 0.5% or something more returns than what your fixed deposit offers you to senior citizens, is because banks kind of consider as their fiduciary to give you that higher return. And the way they manage that returns is they have a cost of borrowing, right? To some borrowers for a bank, sometimes some money they get from a savings bank account. Sometimes they pay different slabs of interest in different maturity time periods. And to senior citizens, they pay a certain higher incentive so that they can cope up with their expenses in a slightly better manner. That is how it's a clubbed expense that banks end up making. Whereas in mutual funds, there is no such provision. As mutual funds cannot treat one investor different from another investor, and therefore cannot offer a higher return. And whatever returns that mutual fund makes from all their investments that they make are all passed on to the investors. So therefore, there is no mechanism as such, because we cannot treat two different investors differently. And whatever returns that, because banks are doing lending of that, and therefore their different investments make them different returns and have a different cost of borrowing. Here, we have to give the same return to all the investors. So as of now, I don't see a possibility unless there is a change in regulations that allow that.
Chirag, for senior citizens, safety of investments is priority, and that is why they opt for fixed deposits, even though the ROI is less. So, do you think mutual fund schemes can ensure the safety and at the same time pave way for increased or higher returns?
So mutual funds disclose, what kind of instruments they are investing in, and therefore it is very, very predictable in terms of the risk that you will end up taking with that instrument. Now with the riskometer, it's even much more dynamic. It allows you to tell you that what kind of risk you end up making or taking with that investment. But as a senior citizen, I will only say that I know each of y'all have certain different buckets, if I may put it that way. Some bucket is for your monthly expenses, which has to remain sacred. You cannot take any risk with that. It has to remain in a asset which gives you assured returns. And I will also suggest that you diversify it to a few banks at least, right? Second is there is a bucket which you're looking for to generate that long-term wealth, right? Something for inheritance purposes, right? So that is the money where you can take slightly higher risk. I'm not saying you take overt risk and go into equities, which will not be a prudent thing to do unless if you have excess wealth and you want to kind of leave it for your future generations. That could be that you could take some risk, but otherwise, still there is an ability to take some portion of risk which is not therefore needed for your monthly expenses purposes, that you can park into assets like multi-asset funds, and be sure that it is a multi-asset fund which doesn't take overt risk, which is looking to reduce risk at all times. And that is the place where you can park that money, and you can ask the fund managers in terms of what is their objective. Are they trying always to maximize their return? Then that's not. If they tell you that risk comes first and returns come secondary, then that is the place that where you can park your money, right? So something like the quantum multi-asset fund, where we are consciously trying to reduce risk at all times, and at the same time, our track record suggests that we have been able to earn that higher income that you're looking for over and above what your FDs are offering, and therefore the part of money or part of bucket that is there for slightly longer term, you can shift that to that kind of instruments. But otherwise, whatever is very essential money, please don't take risk with that.
Sure. Once I switch out of a bank FD into a mutual fund, my regular interest stops. SWPs can only commence after a year. So, what is the solution?
Yeah, so to till that extent, you can, I mean, stagger your buying as well. You don't put in all lump sum or switch lump sum from fixed deposits to mutual funds. You can stagger your buying as well. So you can do an SWP from your fixed deposits, and at the same time start increasing your SIPs in multi-asset funds, and that is how you can make the switch. You don't go it one way or lump sum. You just stagger your investments, exit from FDs, and moving in the multi-asset fund.
Sure, sure. Lastly, my investments in FD are capital protected. Multi-asset funds do not guarantee this capital protection. How can I consider them as an alternate?
Of course, there is no capital protection, but if you need to get that higher return, which is very, very necessary today to beat inflation, right? Because in a FD on a real basis, you are still losing money, right? Though it is assured return, what is the use of that assured return if you're getting 5% and inflation is 9%, right? On a real basis, you end up losing 4 percentage points. So invariably, you are taking a risk being in fixed deposit, right? Here, you're increasing the chance that on a real basis, you will get that return which is needed today to fight that inflation, right? So although it is not assured, not guaranteed, but you can bank on the track record that you have seen on a 3-year basis. Never it has given a negative return, right? I'm not saying that it will stay true, but the kind of process that we have will make it more predictable, because at each point we are trying to refrain from taking risk. And therefore, whenever it warrants to, we kind of take that small risk to get you that better return, right? So if you're convinced that that process is real, the track record is real, and therefore it is a replicable return or replicable process that we have, then you could start trying that and slowly switch into the multi-asset fund. It is not guaranteed, never will be guaranteed, but you have to sometimes take that leap of faith, not only leap of faith, but an educated leap of faith, right? You can make yourself aware what are the risks. You can ask us what are the risks, what are the return potential, what we have seen across time frames, and that is why we dissect the performance into various time periods and give you and show you what you can expect and what you cannot. So although it is not guaranteed, but it is still a good way to move into taking slightly higher risk into an instrument that can give you a better return while taking a smaller risk, but at least a risk that it will help you fight inflation today. So on a real basis, at least there is a chance for you to make money and take little risk. Whereas on the other hand, on a real basis, although it is a short return, you are losing money.
Chirag, what is the recommended allocation to debt funds in one's portfolio? And if one was to invest in QMAF instead of debt funds, what would be the allocation to QMAF?
So QMAF, I think it is an, as I said, alternative to fixed deposits, right? So debt allocation will depend on a lot of things, right? All your asset class allocation will depend on a lot of things. One is what is the kind of risk profile you have, what is the kind of risk taking ability you have, what is the market cycle that we are in, what is the optimal allocation at this point in time, into equities, into debt. So that keeps changing depending on age, your cash flows, your risk-taking ability, and at the other hand, where in the market cycle we are in, right? So all these will decide how much to be in equities, how much to be in debt, how much to be in gold. So I think if you have a debt portfolio and if you're willing to wait out on a minimum 3-5 year, that kind of time frame you have for your debt portfolio, then I think your entire debt portfolio can be through multi-asset fund. Of course, setting aside emergency corpus. Emergency corpus has to be very, very safe into instruments like fixed deposits or in liquid funds which don't take risk, that kind of assets, right? Apart from that, any debt exposure that you have could be in the multi-asset fund. But allocation will depend, like for the multi-asset fund today, depending on the market cycle we are in, we are around 55% into debt. So if that matches to your risk-taking profile, then you could be 55% debt. And I think out of that, around 50% could be in the multi-asset fund.
Sure. Chirag, 40% of the fund's portfolio is currently invested in the liquid fund and about 10% in the dynamic bond fund. So our investor wants to know how you go about deciding the allocation between the two.
Sure. So the allocation depends on a few things, right? It depends on what are the yields being offered by the bond fund and what are the yields offered by the liquid fund. That is one determinant. I'm talking about the portfolio level yield. Second is what kind of additional return that I can generate being in the bond fund. Is there a possibility today to make a capital gain or a capital loss on my bond fund? Today, the chances are the yields may inch higher, and therefore there is a possibility of a capital loss. And also, bonds being a risky instrument, we want to cap our exposure to a certain level, not take over risk. And because why I have that exposure today is because equities are expensive, and therefore, although they give me better returns, in terms of liquid fund, or at least they will not give me a negative return in a span of time. But whenever there is a chance or ability to go ahead and move money into equities, it can be easily done without having a capital loss from a liquid fund, then a dynamic bond fund. So all those considerations help us decide what kind of allocation should we have within the debt bucket into the liquid fund and into the dynamic bond fund. Today in the dynamic bond fund, the risks are higher at 6% yield today of a capital loss than a capital gain. And therefore our exposure is lower to an extent in a bond fund as compared to the liquid fund.
Sure. Is the algorithm on maximum minimum equity, debt, and gold allocation constantly being back-tested for the multi-asset fund, or is it standard?
Yeah, so before we launched the fund, we kind of back-tested it for about since 1999 till 2012. So kind of we have back-tested a very long time period. And what predictability we saw in our back-testing period was also eventually seen in the real track record that we saw. So what we had expected is a better return and lower risk, lower volatility. And that has transpired when we saw it in the real world. The only difference is our earlier backtesting period had a good amount of volatility in equity markets, like what we saw in 2001 to 2003 period in equities, and 2008, 2009 period in equities, which we have not seen really since 2012. So if we get such kind of big cycle in equities, right, we have not got it because central banks have intervened in a very big way in each time when we saw a crisis. That is why we haven't been able to see the real big cycle in equities. But if we see that, I'm sure the returns will further augment than what we are seeing it today. So yes, everything is back tested. Everything we monitor on a real-time basis every day. And therefore, that gives us that agility to take that right calls whenever it's required.
Sure. Chirag, how do you compare the quantum multi-asset fund with other hybrid funds?
So other hybrid funds out there, I think what investors should be aware is what is your asset allocation pattern, right? As I've said, many of them have minimum equity allocation at 65%, right? Is that a hybrid fund, a multi-asset fund? I think it's really unbalanced. They call it balanced funds, but I think they are very, very unbalanced, right? Because even if the fund manager doesn't like the equity market in terms of valuation, even if they think it's very, very risky, it doesn't allow them to substantially reduce their allocation. They have to, by mandate, be minimum 65% allocated to equities. Whereas we have that flexibility to kind of, if we don't like the valuation in equities, if it is very risky, we can reduce it to 25%. So there are very few funds out there who have that flexibility, so that they can minimize the risk for investors. So when you look at other options, you have to be very, very careful in terms of the ranges of asset allocation that they have. I think that is where we have superiority in terms of helping investors reduce the risk and still get that higher return that they are looking for than the fixed deposits. So many allocations which have minimum 65% allocation, I would say that they are not really a balance and therefore not really an alternative to fixed deposits, because we have seen even at time of COVID, when markets fell, many of these balance funds fell so aggressively, and investors were saying that this fall is looking very, very similar to what I see in my equity funds, right? So are they really minimizing risk? Are they really balanced? No, right? And therefore investors, when they're looking for options like this in terms of in lieu of their fixed deposits, they have to see whether the fund manager has the ability to minimize the downside risk or not.
Chirag, is quantum multi-asset fund taxed like an equity fund or a debt fund?
No, quantum multi-asset fund is taxed like a debt fund, which means that up to 3 years, it will be taxed as per your tax bracket. And after 3 years, it will be taxed at 20% with indexation. Because of the indexation benefit, the effective tax rate comes at around less than 10%. So whatever gains you will make, right, you will end up paying 10% of it on a calculated basis.
Sure. Chirag, do you suggest lump sum or SIP investment in the multi-asset fund?
I will suggest it's going to be a lump sum unless you are trying to time an exit from a fixed deposit and entry into like the question that was previously asked, that how do I ensure that I still get my income from this, whereas I am waiting for SWP from my multi-asset fund. For those kind of investors, it could be SIPs, but otherwise I will say it's lump sum, because the fund manager is taking that call on your behalf to time or change allocations in a way that kind of gives you that better return at a lower risk. So you leave it on the fund manager, and therefore, given that's a fact, you kind of do a lump sum investment in multi-asset fund.
Chirag, why is the allocation towards Quantum India ESG equity fund comparatively lower in the multi-asset fund?
Okay, sure. So what we are doing is we are diversifying the allocation in the multi-asset fund in the equity bucket also. So it's not that diversification is across asset classes. The idea is to, within the asset classes, also give you diversification in terms of exposure to different styles, like long-term equity fund, the quantum ESG equity fund, and the quantum Nifty ETF, right? So it's an asset allocation play, which is diversifying across asset classes and within asset classes. Quantum ESG fund is still has a limited track record, and therefore today's allocation to our equity is around, say, 25-26%. So we are at about 10% of our equity allocation today, right? Over time, as we see more track record of the ESG fund, it will increase to 15 or 20%, depending on how we see it in terms of track record. So over time, we will surely increase our allocation, but the time is, what we're trying is to diversify across across styles and not take over risk with a particular style. Our allocation will be somewhere, say, 60-20-20 or 70-15-15, where the bulk of the allocation will go in the Nifty ETF, because it allows you to smooth entry and exit without any exit loads whenever there is a need to. And the smaller allocation of 15-20% each in the long-term equity fund and the ESG fund, so that we are not exposed to a particular kind of style. Because you would have seen like 18, 19 time periods, the value strategy kind of underperformed, and we don't want to take that style risk that leads to underperformance. And this time when it has really done well, we don't want to over rely on it as well. So we want to minimize that style risk, and therefore this is the kind of allocation strategy we will have in equities.
Sure. Chirag, is the multi-asset fund good for a long-term period, say over 10 years, or is it better for 3 to 5 years?
So I think most people, what we do is we kind of park money in fixed deposits and kind of keep rolling it over, because we don't really need that money. It's there for long-term capital appreciation, but we don't want to take too much risk with that money. And that is why we don't go into instruments like equities or other instruments like gold or debt in a very big way. We kind of have bulk, like what data suggests, the bulk of India is in fixed deposits, right? 50% of the money that people have is parked in fixed deposits, right? Even if we don't need it for the long term, it's still there, right? So I think any exposure that you're looking for a steadier return, right, and not that fantastic over return, but still doing better than your fixed deposits, any time frame I think is good for a multi-asset fund. But minimum I will suggest is 3-year time frame. Longer the better, but always remember that it will give you slightly higher return than your fixed deposit and slightly take higher risk than your fixed deposits. So that is the broad framework under which you have to understand in which it operates. And whatever money you are willing to keep as safe, but you don't need it for long term, that all money can go into multi-asset fund.
Right. Chirag, though interest rates are low currently, what is your view on interest rates over the long term, say a 5-year period?
I think interest rates, if you see that chart that I showed you, have been inching lower, right? If you see the cost of capital in the global world has also inched lower. But from here on, how much lower? From here on to it to dip much lower will take some more time. It has come down significantly from that 10, 11, 12% to around 5, 6%. It may remain in this range for some time, but it will take a while for it to dip further, right? So probably we are looking for some stickiness around these 5, 7% range. This is a chart that I was referring to, where interest rates have come down from 10, 12%. Post that, the range came down to 6 to 8%. And I think it is now lower to say 5 to 7%. But from here on, because we have an inflation problem, and to give savers a real interest rates, RBI may be compelled to not allow it to fall further from here. And therefore, because inflation in India will remain around that 5.5% mark always, even in reported numbers, right? Therefore, interest rates will remain around that 5 to 7% for some time. And as we see some gradual reduction in inflation, it may open up some room for it to follow. So anything inching from here in a hurry, I don't see that happening significantly. It will stay around that 5-7% mark and gradually lower to say a 4 to 6% band maybe in the next few years' time.
Sure. Chirag, with such low allocation to equities in the fund currently, are you expecting a correction in the market?
The valuation suggests, yes, that we are kind of in an overvalued zone. Given the uncertainties out there could be corrections. For example, the COVID second wave is scaring global investors. If they start exiting, there could be fall in equity markets. And equity markets, if you see over last month or so, have been really choppy. In last month, the month of April, FIIs withdrew about $1.3 billion out of equity markets. If there is no respite, because if you look at the framework today, what is happening is a big infectious second wave. That was a similar kind of wave were also seen in developed markets like Europe, US, UK, right? what they did, what many of those economies did is they kind of went into lockdown, they kind of vaccinated a lot of people, and therefore now they open up. The things are much better because there is some immunity because of the vaccinations being given to a lot more people. For example, UK in a short span of time vaccinated about 60% of the population, right? That is how fast they went about and changed things. What we are doing, we are having a lockdown, but not vaccinating people. So what this will tell us as we open up again, because of lockdown, cases will go down, but as economy opens, again, we will surely get a third wave. So until we kind of have a big approach towards vaccination, I don't know how we're going to get that those many vaccines, but unless we vaccinate a lot of people, we will have this pattern of start, stop, impacting the economic activity across India, right? And therefore, this could lead to some nervousness for these foreign investors because this second wave has been tragic, the kind of spread that it has had, the kind of deaths it has had, and much of the numbers that we see are very, very underreported, right? If the testing is lower, therefore cases are lower, and therefore deaths are lower, right? Because we are not even finding out that whether that person had COVID or not, right? And that person is getting infected, is dying. It's tragic, right? So unless we have a good strategy towards vaccination, I think we will have some uncertainty because of that, and that uncertainty could really feed into economic activity, and therefore profit or revenues of companies, and therefore there could be some correction.
Sure. Chirag, why is there an upper limit of 65% in the asset allocation with respect to equity? Won't the fund have better flexibility and potential for higher returns if this upper limit is increased?
Yeah, sure. So there are two things about it. No matter how predictable things look, there have been certain episodes that could lead to a certain surprise that could lead to many declines, right? Which are kind of unpredictable. Like COVID was unpredictable, but demonetization was unpredictable, SARS was unpredictable. So there are episodes, even with all your might, are not predictable, and therefore not to take that higher risk. And in our framework, we have tested across these stress testing episodes that come through and the ability to take that risk potential that investors would likely have, we thought it optimal to cap it at 65%. So it's a mix of what we have seen in terms of stress testing and therefore the losses that could follow, and the ability of investors to kind of bear that risk or losses. And therefore, we thought that capping at 65% to get that optimal risk reward framework. And that's an effort of all the back testing that we did, all the stress testing that we did. And it is out of thorough research that we kind of fixated our bands at 25 and 65%. Because when we are designing this product, the aim was to give a return which is very, very predictable, higher than fixed deposits, and with minimal risk, and therefore the 25-65% band.
Thanks, Chirag. Chirag, given that the multi-asset fund is a fund of fund, does it have double expense ratios, and how does that impact the investor?
Yeah, that's a very good question, I think. So when it is a fund of fund, investors usually kind of frown that there will be a double expense and therefore a bothering for me, right? But that's I think a notion which could be proved wrong by numbers, right? So it's there a misconception that always a fund of fund will lead to double expenses and therefore double cost for me. But you don't see the benefit side of it, and you don't see the numbers, what it really means, right? So if you look at the multi-asset fund, firstly, being a fund of fund, there could be no dual management fees levied by the fund house, right? Especially when you're investing in your own products. When you're investing like the multi-asset fund, invest in mutual fund schemes of quantum mutual fund itself, and therefore there can be no two layers of management fees. What the multi-asset fund charges for all the allocation that they do is 10 basis points for fund running expenses, right? what is the effective cost for investors, right? Today, if you are in a multi-asset fund, the blended expense ratio of all the underlying schemes and also that of the multi-asset fund is around 58 basis points, 0.58%, right? Total, all everything combined, right? And across the allocations, it will still remain between zero. It has remained around 0.5% to 0.91% in that range. But kind of the changes that we have made in terms of allocation, it will stay between 0.5 to 0.7% all combined, right? So to get a and all the returns that you're seeing is after expenses. So after expenses, it has given you better returns than your fixed deposits, and overall cost is not that high. Today, it stands at around 0.58%. Even if your equity allocation increases, it still will be around in the same range, 0.6, 0.65% in that allocation range. So it is not very tedious on investor pockets. It is still very, very low as compared to various other options out there. So overall, we have ensured that you get a better return than your fixed deposits. And at the same time, the costs are not that high. The total combined expense ratio, I'll reiterate, is 0.58% today.
Thanks, Chirag. Another question that is coming up often in the chat is, given that the AUM of the fund is small, does that impact the investor or does it impact returns in any way?
This is again a notion that needs to be well understood by investors, right? When you're looking at a fund lower AUM never impacts the fund. Usually it is a higher level of fund size that starts impacting the style in which the fund invests, and therefore the predictability and the process and the returns that the fund has, right? When you're looking at a fund and the instruments that it invests in, that will tell you how or the liquidity of the underlying instruments will determine whether the fund will be able to enter and exit with ease or not, right? So today, underlying schemes like the long-term equity fund, like the Nifty, like the ESG, like the dynamic bond fund, like the liquid fund are all very, very liquid, invest in turn into liquid instruments, and therefore scaling this fund size to even 10, 15, 20,000 crores is never going to be a challenge for us. We have designed it in such a way that it can scale without us changing the style or characteristics of the product, and still at that higher AUM, give you that same predictable return profile, risk return profile that you're looking for, or what we have seen, and therefore coming in the fund. So that's not going to change even despite higher size, nor the lower size is impacting us in terms of how we invest or how easy we enter or exit any instrument that we have invested in.
Chirag, would you say you missed out on the equity rally of 2020 since you trimmed your equity allocation post-April?
So it was not post-April. We gradually kind of reduced it. We kind of, in that 1 month when we saw markets falling, we kind of increased it to 50%. And over next few months, we brought it down to 25%. So we got bulk of the gains. And as market kind of went into some frothy levels, we were at the lower end of our spectrum in terms of allocation. So there will be some misses. There'll be some in terms of not fully staying in that asset class until we reap all the returns. You will never be able to catch the top. You will never be able to catch the bottom. It's better that you kind of stay invested in such a way that you kind of get good returns. For any investor, I think over last 1 year, though it pales in comparison with equities return, still a 16% return that multi-asset fund has generated is good enough return that investors will be happy with, right? So I'd have no regrets missing that just the last fag of the rally in equities. But I think I have done what is mandate given to me by my investors, that is to lower risk whenever I cite risk, right? Valuations were clearly inching higher, and therefore it was only prudent to reduce my equity exposure And each time when that happens, we'll do the same thing.
Thanks, Chirag. Next question. How does the multi-asset fund compare with the dynamic asset allocation fund in terms of returns and risk?
So I think I've answered it previously to some extent in terms of the dynamic asset allocation risk. You will always have to see which dynamic asset allocation category or fund that you're referring to. If they are minimum 65% equity allocation mandate, then they are significantly very risky as compared to our multi-asset fund. Because in a multi-asset fund, in a frothy market environment when equities are going berserk and doesn't make sense at that valuation, those funds will still be at 65% equity allocation. And when markets fall, they'll bear the brunt. Whereas at that point of time, I can say that we surely be in a frothy valuation environment at 25% equity allocation. And therefore, the fall that we will see will be significantly lower, much lower than what those 65% will see. Of course, the 65% equity, if it falls, it will see a far higher losses than what we will see at a 25% allocation. So that's the big difference between those funds, because though they are kind of sometimes referred to as balanced funds, they are not really balanced, right? They are very imbalanced in terms of their allocation. That is what we have tried, is to create a real balanced fund for you.
Sure. Chirag, I think you answered this as well, but we have a specific question. If a person is looking to retire in 10 years, would you recommend that he invest a significant sum in the multi-asset fund and then start an SWP after 10 years?
So I think that will be a good strategy. Depending on, I will suggest a two approach to this. I think you can either play a plain vanilla multi-asset fund, do an SWP, that will work very well if you're okay with the returns that you have seen for the multi-asset fund, and if you're happy with that. Or if you want to augment that return, then you can add a little bit of equity exposure on your own that can help you augment return for the next 10 years. And thereafter, because at each point in time, what we will do is try to reduce your risk. And if you're happy with that approach and you're happy with a steady return, which is more than your fixed deposits, then I think it will work wonderfully well for you. A plain vanilla approach, just do a multi-asset fund and do an SWP, that may work well. But if you want to augment your returns, then you can add some equity exposure on your own. And that could also work well for you, only if your risk appetite permits that. But otherwise, a multi-asset fund, as you have envisaged, is a good solution.
Thanks, Chirag. Chirag, for someone who wants to take advantage of the 40,000 tax-free limit in FDs, would you recommend a complementary strategy where they have some amount invested in FDs and then they complement that with an investment in the multi-asset fund?
Yes, that could work too. I mean, that 40,000 rupees. But if you've seen, I think, if I'm not wrong, I'm not an expert on FDs because I don't do much FDs. But if you look at those tax-saving FDs, I think they have some lock-in periods of 5 years or so. And I don't know about the rates that they offer. Sometimes they are inferior to what your regular FDs offer you. So if you're happy with those returns, yes, you can augment that as well. Because at least for that could be part of your emergency corpus, which I will suggest you keep in something that's a short return for you. But the lock-in element can hamper that emergency corpus as well. So, but I get where you're coming from. Yes, you can do a multi-asset and an FD in a combination.
Sure. Chirag, you mentioned that higher inflation is on its way. But don't you think, given the second wave, going on in India, it will impact demand and bring down inflation?
So, despite we are going through second wave, if you look at global commodity prices, are still at record years. They are trading at some commodities are trading at 8-year, 10-year, 12-year highs. And not only India, much of the global world is going through a lot of this commodity price increases. And India, in most of the commodities, is a recipient of price, not a price maker. So if aluminum price is at X level, we have to trade or we have to buy at the next level, right? If it is, say, if copper is $10,000 per ton, you have to buy it at $10,000 per ton. We don't make copper. Most of it is imported. We kind of just do treatment refining here. We don't govern the prices. It's governed by the global prices. Second is there is so much liquidity being pumped by the central banks. It is an aftermath of this liquidity, right? If you look at US alone, their balance sheet size went up from $1 trillion to $4 trillion, $4 to $5 trillion. And if you combine all central banks across the world, this increase in balance sheet size or increase in money printing in other ways is humongous. So they have put in around 10, 11 trillion dollars in total across all central banks into the economy. And this will lead to inflation this time because unlike 2008 crisis where they again pumped in a lot of money that stayed in the financial institution circle, right? It didn't go to the real economy. It remained in the financial economy. This time, if you see governments are spending, they are borrowing from the central bank, they're spending it out, they're giving handouts, they're supporting businesses, because lending it or giving money freely at all levels, and the cost of money is very, very low. So overall, I think this inflation is here to stay. I don't think it's gonna dip anytime soon. So inflation, despite COVID, we have seen surge, and therefore, even if COVID continues, because no matter if India is cooling, there are other economies in the globe like US, UK, which are far better off and opening up. And governments there and the central banks are hell bent on spending as much as they think is needed to support the economy and to revive growth. So I think that pattern, that is a vicious circle which is keep on going, and therefore inflation may here to stay for longer than what we kind of wish for. So inflation may not go in a hurry, and despite a second wave, we will still bear the brunt of inflation. And despite that, inflation in official numbers in India will continue at 5.5%. There could be periods of 7-8%. There could be period of 3-4%. But on an average, we still will have in official numbers 5.5%. And consumers like you and me, we have seen inflation of around 9-10% for a long period of time. So at a retail level, at a consumption level, I think that consumption basket will still continue to inch at not even, if not at 9-10%, but at least at 8-9%, higher than the official numbers. So I think whatever the inflation be on a real basis, FDs will still be a losing proposition, and therefore it makes sense for investors to move out of fixed deposits and go into such instruments.
Thanks, Chirag. One more question before I ask you for your closing comments. Isn't a 10 to 15% allocation to gold at all times counterproductive during a down cycle in gold, which tends to last for a few years?
So there could be down cycles, but as you saw that slide where we kind of told you about unknown risk, right? So today there could be unknown risk from which corner, I don't know, right? No one predicted COVID, but still that was a risk that everyone has to live with. And in that period, gold was one asset that kind of did really, really well and helped portfolios tide that uncertainty. And despite that gold falling after that, doesn't make me worry. So we have seen time and again, gold comes to rescue your portfolio and therefore helps your portfolio tide that uncertainty that can come from any corner, any side, not be in India, be it from globe or be it in India. Because whenever there is an uncertainty, markets fall, rupee goes for a toss, my gold investment in rupee terms will do much, much better, right? So it really helps you when other assets are stressed. So despite having a 15% allocation, I'll pray hard that tomorrow gold falls by half, right? If it falls by half, my other 85% would be doing much better at that point in time. So when that 85% is not doing well, I better have that 15% will help me tide at that point in time. So I don't regret at any point in time, no matter a bad cycle comes for gold, I will not regret that allocation in my portfolio and always warrant that because you don't know where the risk is coming from. And if you look at returns from gold, long-term returns, right? That is very, very essential to see, right? If equities are given 12.5%, and if you think it's the best performing asset class, gold has not done that. For a long period of time, it has given me 11.4% return. Tad lower than equities, but volatility is also lower. So adjusted to volatility, it has done at par with equities. So it is a myth that gold has bad cycles and therefore doesn't give me good returns. It helps me during uncertain times, and over long period of time, it has given me good returns as well. So I'm happy with my 10 to 15% allocation.
Thanks, Chirag. So with that, I'd request you to summarize for our investors what you would say are the key USPs of the Quantum Multi-Asset Fund.
So firstly, I think break the shackles of FDs, slowly start moving to instruments. I think that can give you better return while you watch your risk, right? You can allow that fund manager or outsource it to the fund manager to watch the risk on your behalf. And there are instruments available today which are time tested, which are have a track record, which are predictable, and therefore you need to make that switch today, right? Second is in the multi-asset fund, we are always watching and trying to lower risk at all points in time. Wherever we cite a risk, we will try to reduce that risk by lowering allocation to that asset class or to that asset at that point in time. So what we are trying to really do is give you that predictability of performance, better returns than your fixed deposit over at least a 3, 5, 7 year period. And at the same time, you end up taking slightly higher risk because we are watching your risk. And so it's time that you have an instrument, you know something that's not working for you, make that switch today.
Thank you, Chirag. Thank you so much for answering those questions so patiently and for the great presentation. It was a pleasure to have you with us. Though we have tried to cover as many questions as possible, if you still have any queries, we'd love to hear from you. Please visit our website, www.quantumamc.com, and feel free to write to us. For those interested, the recording of this webinar will be posted on the official YouTube channel of Quantum Mutual Fund next week. So this concludes our webinar. Thank you all for attending. We hope you have learned from and enjoyed this webinar. Good night.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.